History has a favorite trick. It makes us believe that because our tools have changed, our nature has to. We look back at the 17th century Dutch trading a single tulip bulb for the price of a canal house, and we laugh. We call them irrational, call them blind. We look at the South Sea Company in 1720, where even Sir Isaac Newton, the man who mapped the laws of gravity, lost his fortune, and we think ourselves superior because we have high-speed data and sophisticated algorithms. But a bubble is never built on stupidity. It is built on something much more dangerous, a truth that is stretched until it snaps. You are watching Money History Lab, and today, we aren't looking at the charts or the candles. We're looking into the mirror. We're re-exploring the architecture of mania, the psychological scaffolding that allows the smartest people in the room to convince themselves that gravity no longer applies. Every mania begins with a seed of reality. This is the fundamental lesson of the lab. In the 1840s, it was the British Railway. The steam engine was real. It was changing the world, was shrinking distance. In the 1920s, it was the radio, the first time a human voice could enter millions of homes simultaneously. In 1999, it was the World Wide Web. These weren't fakes. They weren't frauds. They were genuine, world-altering revolutions. But here is where the chemical reaction of history becomes volatile. When a technology is truly revolutionary, it creates what we call a narrative void. Because the potential of the technology is so vast, we don't know where the ceiling is. Our imagination rushes in to fill the gaps that math cannot yet reach. We stop asking, what is this company worth based on its current cash flow? And we start asking, what could this be worth in 1,000 years if it changes everything? When a story becomes too good to check, math becomes a nuisance. In the Roaring '20s, if you questioned the valuation of radio stocks, you weren't viewed as a careful steward of capital. You were labeled a dinosaur, someone who simply didn't understand the new era. This is the first pillar of a bubble, the rejection of old metrics. We see it every time, whether it's price to clicks in 1999 or compute per dollar today. The market always invents a new language to justify prices that the old language cannot defend. As the bubble matures, it develops a sophisticated immune system. Psychologists call this social proof, but in the markets, it's a form of collective hypnosis. Imagine you are an investor who values safety. You stay on the sidelines while your neighbor, your brother-in-law, and even your most conservative coworkers are doubling their money every 6 months. At first, you feel wise. Then, you feel cautious. Finally, as the prices continue to climb, your caution starts to feel like a personal failure. It starts to feel like poverty. This is the FOMO threshold, where the pain of being left behind becomes greater than the fear of losing your principal. At this stage, the market is no longer a place of commerce. It is a place of compliance. You aren't buying an asset. You're buying a membership to the future. And anyone who points out that the foundation is cracking is unjust seen as wrong. They are seen as an enemy of progress. This brings us to the most seductive part of the cycle, the era of institutional validation. In the early stages of a mania, it's the dreamers and the gamblers who drive the price. But the bubble doesn't reach its peak until the adults enter the room. This is when the most respected banks on Wall Street, the massive pension funds, and the government regulators begin to endorse the narrative. They release 500-page reports explaining why this time is different. They create new indexes to track the trend. They lower interest rates to keep the engine running. When the authorities tell you the sky is the limit, your last shred of skepticism evaporates. The smartest people at the most powerful institutions are buying. Who are you to disagree? This is where the risk is at its absolute highest, precisely because the perception of risk has been engineered to zero. Let's apply the lab's lens to our current moment. We are told we are in the midst of the AI revolution. And let us be clear, like the steam engine or the internet, the technology is real. The productivity gains are measurable. The potential is breathtaking. But history asks us to look at the structure of the belief. Look at the concentration. Today, a staggering percentage of the world's wealth and market growth is resting on the shoulders of 5 or 6 titan companies. We call this efficiency and dominance, but history calls it systemic fragility. When a bubble is concentrated in a few symbols, the narrative is easier to protect. We tell ourselves that as long as these god-tier companies keep spending tens of billions on hardware, the music will never stop. We treat their massive capital expenditure not as a cost, but as an investment in inevitable victory. But history teaches us a cruel lesson. Bubbles don't usually pop because the technology fails. The internet didn't stop working in 2001. The railroads didn't stop carrying freight in 1845. They popped because the capital ran out of patience. A market can stay irrational only as long as there is fresh blood, new buyers, and cheap credit to push the prices higher. The moment the future is expected to pay the rent, the snap is instantaneous. When the investors realize that the profits are 10 years away, but the bills are due today, the narrative collapses. The social proof flips. Suddenly, everyone who was buying because everyone else was buying begins to sell because everyone else is selling. The psychology of the crash is the mirror image of the mania. During the rise, every piece of bad news is dismissed as a temporary headwind. During the fall, every piece of good news is dismissed as a dead cat bounce. The same confirmation bias that made us blind to the risks now makes us blind to the opportunities. This is why the majority of people lose money in both directions. They are governed by the herd, and the herd is always late. So, how do you protect yourself in a world that is designed to keep you invested at all costs? The answer isn't in a crystal ball or a secret algorithm. It's in the quiet, uncomfortable practice of self-awareness. You must learn to separate the innovation from the investment. You can believe in the power of AI while simultaneously believing that the stocks are overpriced. You can believe in the future of the internet while knowing that 90% of the companies will go to zero. The most important question you can ask yourself in the Money History Lab is this: what belief am I relying on that I haven't tested? If your reason for holding an asset is simply that it's the future, or because everyone knows it's a winner, you aren't an investor. You're a passenger on a ship you don't control. History shows that dreams are beautiful, but they are a terrible place to store your life savings. True wealth isn't built by catching every wave. It's built by surviving the tide when it goes out. The paradox of the financial historian is that we are always looking backward to understand what is happening right now. We see the same ghosts in the machine. We see the same frantic energy in the trading pits. We see the same desperate need to believe that we have finally solved the problem of scarcity. But history doesn't repeat because the assets change. It repeats because human ego, the desire for easy wealth, and the fear of social exclusion ever does. If you want to see the crash before it happens, stop looking at the ticker. Stop reading the price targets. Start looking at the consensus. When the skeptics have been silenced, when the adults are all in agreement, and when the narrative feels like a law of nature rather than a theory of value, that is the only time you should truly be afraid. The lesson buried beneath every market postmortem is that the danger isn't the event itself. The danger is the certainty we felt leading up to it. In the lab, we don't look for answers. We look for the right questions. We look for the assumptions that everyone is making but no one is saying out loud. If you value this perspective, if you want to build a mind that is immune to the madness of crowds, then join us here at Money History Lab. Subscribe. Share these stories, and let's commit to decoding the future by finally understanding the lessons of the past. Thank you for spending your time with us.